Welcome back. Now this video is a continuation of the previous video where we spoke about the logic behind how your investments will be managed. So if you haven't watched that video yet, please go and watch it first. Because in this video, we will be exploring the technicalities behind how your investments will be managed, starting with the fundamental analysis. Now once again, here are the standard disclosures. I will not bore you with the details. Moving on. Now let's start off by defining what fundamental analysis is and what we as investors are trying to do with it. Fundamental analysis is a method of measuring an investment's intrinsic value. In this case, intrinsic value is known as the true worth of something. Fundamental analysis is important because it helps us make sense of the price that we are paying for our investments today. Now there's this quote by Warren Buffett which says that price is what you pay, value is what you get. To put it simply, the prices that you see on the market today may not be reflective of what the investment is truly valued or truly worth. Fundamental analysis is a way to help us discover the true worth of these investments so that we will be able to draw conclusions as to whether or not the current price is worth paying for. Okay? The concept is very simple. If the investment is priced at $5, but it is valued at $10, the investment is considered to be undervalued and we should buy it. If the investment is priced at $10 and is valued at $10, the investment is considered to be fairly valued and we should do nothing to it. If the investment is priced at $15 and is currently valued at $10, the investment is deemed to be overvalued and we should sell it off. Now that we've understood the basic idea of fundamental analysis and intrinsic value, the next question is, how do we go about to measure this intrinsic value, right? To measure the length of something, you need a ruler. To measure the valuations of an investments, you need indicators. The key indicators that are used to measure the valuation of our investments are the price to earning, price to book, price to sales, as well as price to cash flow ratio. When we are examining this ratio, there are a few key things that I'll look out for, mainly the ratio's current value, as well as its behavior over time, and then from there we can do a very simple forecasting to gain a better understanding of what the true worth of our investment is today. Don't worry, I'll walk you through each considerations one by one and explain to you what the thought process is. So let's start off by looking at the ratio values. For this part of this presentation, I will be using the insights provided by the book, or basically What Works on Wall Street, right? So if you guys want to dive deeper into it, I would highly recommend that you give this book a read. Basically, as the name suggests, the author of this book takes a very statistical approach to backtest the different indicators and examine what actually works on Wall Street going as far back to 1927. Right, without further ado, let's get started. Let's go through the definitions first. Price to earning is defined to be the price that you pay for $1 of earnings that the investment generates. Earnings in this case refers to the take-home earnings after paying off all the expenses. If I sell my phone for $500, but it cost me $400, my earnings in this case is $100. Now, price to book is defined to be the price that you pay for $1 of book value. Book value in this case refers to the accounting book value of the investments, and you get that by taking the assets, which is what you have, minusing off the liabilities, which is what you owe, right? If your house is worth $500 or $500,000 on paper, and you take a loan of $400,000, the net asset value of your house in this case is $100,000. Okay, you take what you own, which is 500K, minus what you owe, which is 400K, to derive the book value of $100,000. Price to sales is defined to be the price that you pay for $1 of sales revenue that the investment generates. And lastly, price to cash flow is defined to be the price that you pay for $1 of free cash flow of the investments. Free cash flow in this case refers to the total cash received after deducting all the cash outflow. Now, I've linked all the Investopedia definition for the above four ratios in the description below. If you are still confused over the definition, please check the links out before you continue with this video. Now, with the definitions out of the way, let us examine some of the key findings of the book. With regards to price to earning ratios, if we were to sort out all the stocks in the universe and group them in ascending order, with each group accounting for 10% of the entire stock universe, what you will realize is that the annualized return rate of the group decreases as the price to earning ratio increases, right? The return rate that you get decreases as the decile or the group number increases, right? Furthermore, if we were to look at the base rates, which measure the probability of beating the entire investment market, you will realize that the group with the lowest price to earning ratio had a very high probability of outperforming the market. And what's more, this probability increases as your investment duration increases. On the other hand, if we were to look at the base rates of the group with the highest price to earnings ratio, you will realize that while the probability of a single year return is decent, this probability decreases significantly year by year. And in the long run, you would have been better off if you invest in the entire investment market or entire stock market itself, rather than the group with the highest price to earnings ratio. Now, all in all, the finding of this price to earnings goes to show that it is not wise to pay too high of a price for $1 of earnings, as the higher the price you pay for $1 of earnings, the lower the probability you will perform well over time, vice versa, right? Sure, some people might point out that there are outlier cases like Amazon or even Tesla, but please be mindful that these companies fall under the 2%, of which how skillful and lucky must you be to identify the 2% of the entire market that could outperform the entire market as a whole in the long run. With regards to price to book ratio finding, the general findings are the same as the price to earnings ratios findings, though there seems to be a little slight twist to it, because based on the graph above, it is evident that the graph that has performed the best is not group 1, which is the group with the lowest price to book ratio, but instead it was actually group 2 and 3. And one plausible explanation for this is due to the fact that a low price to book ratio is often associated and perceived to be companies that are in trouble. And as a result of this, people tend to stay away from group 1 and prefer to invest in group 2 and 3 instead. Right? Apart from this peculiar finding, in terms of the base rates, the findings are identical with the findings of the previous price to earning ratio, where stocks with a lower price to book ratio will have a higher probability of outperforming stocks with high price to book ratios, right? Moving on. Now for price to sales ratio, the findings are identical to the price to earnings and price to book ratio, so I will not be going through the details. Basically, it is not wise to pay for, or rather it's not wise to pay too high of a price for $1 of sales, as the higher the price that you pay for $1 of sales, the lower the probability that you will perform over time, vice versa. The same can be said for the price to free cash flow ratio also, so I will not be going through these details. Please feel free to pause the video if you want to read the datasets itself, okay? Now, based on the findings of the 4 ratios, the key takeaway from the statistics is to not overpay for your investments. Yes, there can be outliers that outperform the market, despite having a high price earning, book, sales, and cash flow ratio, but the percentage of these stocks that can outperform the entire market while having a high price tag attached to it is extremely low. Okay, in the long run, you are better off investing in things that are not overly priced, regardless of whether you're seeking for stability or you're looking for growth from your investments. It is never wise to pay too high of a price for something that's worth a certain value. Okay. Now that we've understood what works on Wall Street, the next thing is to identify how much is too much in terms of the price that you pay for $1 of earnings, book, sales, and cash flow. Notice that throughout the last 5 slides, there's no hard or fast rule that states that a ratio beyond X is good, while a ratio beyond Y is bad, right? For us to understand whether the ratio values of the investment that you're looking at today is high or low, you have to look at how it had performed against itself historically, as well as against its peers or other markets, which brings me to the second thing that we usually look at in terms of our analysis. Now, the second thing that we will usually look out for during our analysis is the behavior of the ratios over time, right? For the purpose of this part of the presentation, I'll be using the price to earnings ratio as an example to share with you the analytical process that normal investors will go through before deriving any usable conclusions. Generally, the logic and the thought process would apply across all the four ratios. When it comes to the behavior over time, it is all about asking questions and understanding what is the cause and effect behind certain behavior. Usually I will examine the interaction between the 1-year ratio, rolling 3-year average ratio, as well as the long-term average. Okay? For the 1-year ratio, these are the type of question that will go through my mind during the analysis. Where are we at with the ratio today? Is this level normal, or should we be concerned about the readings? What is the cause of these readings? Is there a shift in the price, or is there a shift in the earnings, book, sales, or cash flow? Right? Is this 1-year reading still useful based on the current situation, or are there outliers that may cause the ratio to be irrelevant? For example, during COVID, the 1-year readings back in 2020 is completely rendered useless due to the unforeseen circumstances that is happening in the economy, right? For the 3-year rolling average, the purpose of this ratio is to smooth out the readings from any short-term volatility in the fundamentals that we may experience from the 1-year reading itself, right? This will result in a more accurate reading as compared to the use of a 1-year reading itself. And similarly to the 1-year reading, we will adopt the same thought process and go through the same list of questions to seek a better understanding as to what is happening on the ground itself. For the long-term average, it is used as a benchmark to try and assess whether or not the current valuation is over or undervalued. However, you should be mindful that a reading above the long-term average is not an immediate threat, and a reading below a long-term average is not an immediate opportunity, right? The key thing behind this exercise is to understand what are the causes behind the movements and understand why are people willing to pay for a higher or lower price than normal, right? Lastly, we need to understand if the current valuation is sustainable. And if it is not sustainable, what shall we do? Should we increase or should we decrease our risk exposure? Now that covers the thought process when we are examining the behaviors of the different ratios. The last thing that we will do after going through the ratio values as well as the behavior over time is to do a very simple forecasting to provide us with a general understanding of the range of the prices that we should be looking at under normal, under, and also overvalued situations. Now the way we do this forecasting is very simple. All we have to do is to stress test the different parts of the formula and work backwards to derive the price that we should be looking at. For example, if we are trying to calculate the price using the price to earnings formula, all we need to do is to manipulate the earnings per share and the price to earnings variable to derive a projected price level. Right? You can either manipulate the earnings per share to simulate changes in future growth rate in the earnings, or you can manipulate the price to earning ratio to simulate the investor's willingness to pay. Usually what I would do is to do out a scenario analysis and stress test the growth in earnings in both directions, as well as assign a valuation ratios that I deem to be overvalued, undervalued, or fairly valued. Okay? And once you have done that, you will have a rough sense of what is the price level that you are looking at in each of these situations. And from there, you will be able to look at the behavior of the current price and compare it with the hypothetical price movements based on your projections of earnings as well as the valuation ratios. Now the whole idea of this exercise is not to identify a target price, though you can do that as well. But for me, the idea of this exercise is to determine whether or not it is currently safe to invest or remain invested. If from your analysis you realize that it is still safe to invest, you can either do nothing or invest more. If you realize that it is not safe to invest anymore based on your analysis, then you should take action to reduce your risk exposure. That is the whole idea of this forecasting exercise, right? Now that covers the things that we will usually look out for in our fundamental analysis exercise. Long story short, you need to understand the meaning of the ratio values as well as its behavior over time. And from there, you can do a very simple forecasting to derive a target price or to give you a gauge of the current market situation to determine if it is still safe to invest before you decide on your next action. Do note that I've only highlighted the more important elements that I believe everybody should be aware of, but not the full process that I usually go through when it comes to my own analysis. If you want to dive deeper into the fundamental analysis part, I'll be coming out with a video on the recommended books that you should read to pick up fundamental analysis as a skill. So do smash the subscribe button to stay updated with future videos. Now, investing is a mix between art and science. While the projections are useful in helping you understand what the next best course of action is, they are by no means absolute, right? Investors should focus both on the art as well as the science element when analyzing the investments instead of just relying on one aspect of the process. For the purpose of our investments, we will use fundamental analysis simply as a gauge of the current market situation and to determine whether or not it is still safe to invest before deciding what our next course of action should be. Now that covers the entire fundamental analysis behind how your investments will be managed. Thanks for sticking around the entire presentation. If you haven't subscribed or connected with me on LinkedIn, please do so to stay updated with future content. If you have any questions with regards to this video, you can drop me a comment on this channel or PM me directly via LinkedIn or Telegram. All the links will be on the description below. Stay safe and I hope to hear from you all soon.